Congratulations! You're about to learn the most simple yet effective trading strategy that I use on my long-term investments and a $1 million portfolio. I will go through everything. You don't have to be a pro trader to understand, and what you're about to discover is going against what most people teach on YouTube. And I'm gonna reveal one secret already. It is that we are not gonna trade with stop losses. And this is only possible because of how we set up our trades and analyze the market and picking what to trade. Very important ingredient. My name is Robert Billing. I'm the founder and CEO of the prop firm TraderFunder.com. I'm a millionaire, a 7-figure full-time trader, coach for hundreds of trading students, entrepreneur and investor of several super successful companies. I say this not to brag, but to give you some background on why you should give me your time listening to what I have to say. I'm not a financial advisor, I'm just sharing how I do things. Remember to stick around the whole video for my biggest secret on how much you should invest and why we trade without stop losses. I mean, everyone say that you must use a stop loss. The strategy consists of 4 parts, and even though you may know any one of these 4 parts, stick around for the whole video because it's not about each individual part, but how they work seamlessly together. And after going through them all, I will show you how to put it together. It's actually 4 very simple steps once you learned it, so no rocket science here. And please hit that like button before I give you my secret sauce. It will inspire me to share more valuable content with you. Okay, let's get into the strategy. Number 1, dollar cost averaging. This means that we will divide our entry into multiple positions. Let's say we were gonna invest $10,000 into the Apple stock. We then divide the trade into 4 equally large piles of money, $2,500 each. You will soon understand why we do this, but basically we are humble to the fact that we have no clue if the price is gonna go up or down from here. Looking at the chart full of candles, there is only one place on the chart that is the actual bottom. So how big of a chance do you think it is that we hit the absolute bottom when we are gonna enter your trade? I'd say with my experience it's pretty much 0 chance. This is why I use dollar cost averaging on my long-term investments. Number 2, choosing what to trade. For this strategy to work, we do not choose high-risk instruments. Instruments is a name meaning anything we want to trade, like a stock, index, crypto, etc. So when choosing what to trade, we zoom out on higher time frames like the weekly or monthly, looking from the start until now, and we want to see a clear direction that the instrument is moving up. Comparing these two, one is a forex pair going up and down all the time, not showing a clear direction. The other is Nasdaq 100, a stock index. This shows us a clear uptrend, so it's way easier to trade than the forex pair. So it's important to pick instruments to trade that we are most certain that will not go to 0. Even though we can never know for sure that an instrument will not go to 0, we can have an educated guess. Do you think that Apple, Microsoft or even Tesla will go to 0? I highly doubt it. So these stocks qualify to trade using this strategy among other similar stocks or instruments. Do we think that the altcoin, Solana or Dogecoin can go to 0? Yeah, possibly, if crypto gets regulated or they go bankrupt, so these do not qualify to trade. So we do not choose crypto altcoins, we do not choose penny or pharmaceutical stocks, they are high risk. Remember, we want a clear direction that the price is moving up with minimal risk of the instrument losing all its value. This is important because we trade without stop losses. Number 3, analyze the instrument you want to trade so that you learn how much it drops on average, when it drops a lot. But before continuing, showing how this analysis looks like, please hit that like button and stick around for the 4th part of this strategy, which is the most important one. And after that, I will explain the secret sauce of the whole strategy and the risk management. Continuing, here we have the Apple stock. I now want to know how much it drops on average using the larger drops spotted on the chart, not the small ones. Looking back to the 1980s, we see some heavy drops: 77, 82, 83, 61, 44, 33, 22, 35, 32. I most often don't use the biggest drops, even though I know it can happen in a worst case scenario. This shows that the Apple stock drops around 50% from time to time. So if we would have entered the trade on Apple now, we would enter our first position where we are now when recording this video at 176. And then every 12.5% drop. 4 positions times 12.5% equals 50%, which is what we decided to use. So the price 88 is 50% drop from 176. So splitting our 4 positions evenly from 176 to 88 would have been having entries at 176, 147, 118 and 88. By doing this, we are armored to handle 50% drops. Number 4, exit strategy, the most overlooked part of any long-term trade. I mean, we focus so much on our entries, but when are we gonna exit? A trade has not won or lost money until you close the trade. Up until closing, it's only open drawdown or profit. An example, you bought Bitcoin at 10,000 and it went up to 68,000. You have made 6.8 times your money. That's 680% if you would have closed it. But if you didn't close it and instead close it now when it's at 35,000, you would have made 3.5 times your money and not 6.8 times. And what if the price moved to 8,000? You would all of a sudden be minus 2,000, which is 20% drawdown. So remember, until you close your trades at any price, it's just open profit or drawdown. Profit or loss is only made once you close your trade in either profit or loss. So my goal is to make 20% on each trade, not position. I call each instrument a trade, even though I split it into 4 positions. The 20% profit is calculated no matter if I enter with 1, 2, 3 or 4 position. It's 20% of the invested capital. So if I only enter with 1 position and it goes up 20%, I close it and the trade is over. Moving on to the next one. Most of the time it never comes down to use all 4 positions. Sometimes it only takes 1 to win, sometimes 2, 3 or at sometimes all 4 positions. This strategy is a lazy man strategy. It takes minimal effort, and instead of using a stop loss, getting stopped out, banking a loss, I commit to one trade and then let the time go by. And once we reach our profit target 20%, we close the trade. After each position entered, I will add a stop order where my instrument is sold automatically at my profit target. We can allow ourselves to trade like this without stop losses by using a solid risk management strategy. This is where the secret sauce comes into play. I never risk more than 10% of my total trading capital on one instrument. As an example, I trade with $1 million in total. This means that on any trade, I will only risk maximum of $100,000. And using dollar cost averaging with 4 positions, that means a maximum of $25,000 on each position. 25k times 4 positions equals 100k. So if one of all these trades go to zero, we will still make money. But choosing the correct instruments, this should not happen. Or you buy a stock index like Nasdaq 100, which goes up around 15% per year without doing anything. But remember, the year 2000 had an 85% drop. But you should know this now when you know how to spot drawdown periods on any instrument. Thanks for watching. Peace.